Your little face.
There's always something. It turned off.
You push the button, man.
Yeah.
You unplug it. Unplug and play back in.
Yeah, it is not the technological internet problems. Sorry though, we'll work through it.
That's right.
Well, I appreciate y'all coming out. My name is Steve Peterson, broker owner. So as we go, I feel free to ask questions as we're going through the presentation. Jason Matthews of Matthews Financial, a great friend and business partner of mine, is going to get up here and give you a bit of an economic overview of where we are in the economy. I think that's important. And then we're talking about opportunity zones. And I used to do this presentation where we talk about opportunity zones and group investing. Those are two very similar and related topics, but also two big topics. So what we did was we broke them apart. So I'm gonna spend the second half going over what is an opportunity zone, the pros and cons, how you can benefit from it, and is it something that you should pursue. So feel free, as we're going through this, to make sure, there we go. Okay. You guys see that? Is that good? Is it centered?
There you go.
All right, so let me give a proper introduction. So Jason Matthews Financial, we've been doing seminars together since like 2011, right?
Almost in 2010, actually.
Yeah, man, so that's like more than a decade. We met kind of during the Great Recession. We're both getting our businesses going, and he's a financial planner with a real expertise in the insurance world. I'm in commercial real estate, so we have synergy. Our CPA put us together. Probably done 30 of these before, and it's both of our passions to kind of grow our businesses through education. So that's why we do these. We do a lot of YouTube content, and he's the foremost expert on all things financial in Oakland, and a great guy and my great friend. He's going to come and talk about the economic situation right now in 2022. Give him a round of applause. Bring him on up.
So what Steve didn't tell you was two things. Once when Steve did meet, it was the internet group, it was a mixer. I tried to put it on in 08, 09. Nobody showed up that night besides Steve, which shows you a couple things. One, doesn't matter what size of the group are, you can find some really good, deep relationships with it, which is great. Right now, we're seeing a shift in the economy, so it's always good to understand what's happening in the economy. Everyone through this crazy shift that's going on right now. As now we was in COVID, now is officially in post-COVID. So it's really good to really understand what's going on. Turn it aside. So let's go. So every year, or not every year, but every month, me and my team at my company, we do an economic report, which we usually send out through email. So if you guys have your email list on there, you guys get it. So everyone about to come the information and data, but we usually pile up in simple terms. So this is March, but we updated the numbers as we progress so far this month, but some of the numbers we're waiting for tomorrow, as tomorrow's the final business day of the month. So let's look at what has happened so far in April. Tomorrow could very change. It's been a very volatile equities or stock market, where one day it looks like everything's going to hell in a handbasket and everything is going well. And let me guys go a little bit deeper first about myself. So I've been doing financial advising since 2004. Started off with New York Life, then was Blood in the Streets in 2009. We saw Barristers Clubs. We saw Washington Mutual. We seen all these companies go leave. And I said, you know what? Let me start my own firm at that point. I was young, 24, 25. I had no responsibilities. So I said, let me start off. And my passion is really educating people on understanding how money works and how it affects all of us economically wise. I think oftentimes we really don't understand how money plays out in all aspects of our lives and other deeper meanings and everything else. But if we understand money, it can actually help out our family, our lives, our businesses, and our community, and make it look a little bit better than how it is now. And so that's why I do it. So far, if you look at the indexes, I should change it in April. We changing it day by day. But so far, I made that error. I tried to do it at the last minute today, right after the closing bell. But the Dow Jones average is down 2.2% for this month. The NASDAQ, which is the big tech companies, is down 3.6%. And the biggest hit is the S&P 500 right now, which is down 5.36 just for the month. We're not talking about year-to-date numbers. We're just talking about the month. So even though today was a huge swing up, overall this month has been negative. Now, traditionally wise, I want to say is usually April is usually the best month in the stock market historically wise, right? People don't understand, but April usually, every year, if we look at April, is usually a positive month. So if the market doesn't turn tomorrow, this will be the first time that April has been negative since 1996.
Wow.
Wow.
So usually if you want to invest your money, invest it in April. So
Quick, and that's even during 08, 09. We had positive Aprils,
April's are
spring, right?
April's usually positive.
Wow.
So this quarter data, here's the first quarter data, and which is very interesting. So the first company overall first quarter, January to March, was minus 9.1% for tech. And we see the huge tech volatility right now. You see that with Uber stock prices drop, Facebook or Meta, you want to call it, is down 50%. You have these tech companies taking a huge amount of hits, which is very interesting being here in the Bay Area, where I read a report yesterday that California has the most billionaires still.
Oh, yeah.
And most of the billionaires came from tech, right? So even though we're talking about this California accidents, all these rich companies and corporations, we still have the most billionaires. But tech is down 9.1% overall, but we see a lot of tech taking a huge amount of hits. The S&P 500, the 500 biggest publicly owned companies, was down 5% for the quarter. And then the Dow Jones Industrial Average, which are 30 biggest publicly owned companies after the first quarter, was down 4.6%. Now, according to research, since 1980, there has been 13 corrections, and if we look at the S&P 500, the average decline in the stock market is usually about 14.8%. And the average length of that correction has been only 92 days. So usually the market might go negative, but it only lasts for about 3 months. However, during that period, the S&P fell by 20% or more 5 times. So since 1980, the stock market, or the S&P 500, the number one index we all look at, has only dropped by more than 20% 5 times, which is crazy, which means usually the stock market has some good times usually over the last 42 years. And if you look at what happened, so here's what happened. Let's go back a little bit more. So we had COVID. The U.S. government printed tons of money. 40% of all money ever printed in the United States was printed during COVID 2020 and 2021. Because of that, the market took a crash. How many of you guys remember the crash when it first happened?
Oh, yeah.
Everybody was thinking, nobody was shopping at first, you were saving your money. Then they printed all the money. They printed your money for the PPP loans, the EIDL loans, the unemployment benefits, and all this other money. And guess what happened to the stock market? It went up. The fastest, after it dropped, it had the fastest bull market, which means the market goes up by 20% or more than we have ever seen. The fastest. Why? Because all the money printed. The world was drinking the Kool-Aid of printing more money. And because of that, and this is, you can't really see it, but if you see it, this blue line right here shows you that it was the fastest growth we ever had in the stock market. You could throw anything on the wall. You could invest in any stock. It was a winner, besides WeWorks. Right? If you ever see We Collapse, you should watch it. It's a great show. I've been binge watching on that and Super Punk, the Uber one. You guys should watch both of those. Really good shows. And those are about just the startup of both those companies. Now, we're hearing a lot about inflation. So the inflation numbers for March just came out. Inflation for March is at 8.4%. And inflation is that we have changed how we consider inflation. So a great website to check out is called the 1980 Standards. A chance of a recession.
You know, we're negative inventory on houses right now by about 3 million. And the supply chain has jacked everything up. We're still feeling that ripple of that canal being blocked up too.
In China shut down, and Shanghai shut down, completely closed because of COVID. supposedly. Some people question China on that, but that's all.
That's tactical warfare.
And some people think it's tactical
Oh, you
warfare.
saying China shut back down?
Shanghai shut down.
Right now?
Shanghai is because
What?
of COVID.
I didn't know
They
that.
said they had the most COVID cases they ever had.
They got like walls around their house.
Are you
About a
serious?
month or so.
Yeah, been like it for last month. Now, some people are questioning it because they say that don't sound right because every COVID, it's confused serious. Every COVID case is the death rate goes down with every COVID a new
Okay.
new variation. So why is yours increasing the highest ever?
Yeah, that's.
I don't know. This whole world is crazy right now. Ukraine, China, India, all
You
this
can't
over.
call it. You can't call it. So what do you think? Okay, on that, and I know we gotta get going. What do you think are some? You mentioned a no-brainer. What do you think are some other investment outside of real estate? I know real estate, but what do you think are some opportunities? You know what I mean? Over the next couple of years.
Couple of things. I think defense is going to be good. So defense contracts with the war and everything, and militarization of those increases. You just seen them do more funding. Biden's pushing more for the Ukraine battle. Also, your staples of things. You still gonna buy that milk. You still gonna.
Yeah.
So traditionally, whenever we had recessions, we always said that for stocks on the stocks and equity side. Also, I think right now, whole life insurance is going to be a little bit fancier and bigger to begin because the insurance company usually buy most of the bonds and treasuries,
Right.
and those interest rates on those dividends are going to go up over the next couple of years.
Nice.
So if you have a whole life policy, I think those rates are going to look better. Things are going to be more attractive compared to when it was in a lower interest rate environment.
In whole life, are your returns fixed? Or
Your dividend rate, which could fluctuate, but they're really based off of interest rates a lot because he owns so much treasuries
Yeah.
and government bonds. So I think those dividends are going to go back up that they're going to give to people.
So basically, if you have it more whole life, or you got whole life, you may be.
Your numbers going to look better than what they were originally illustrated to you.
Okay.
I think that's going to happen, but like I think the staples are going to be your energy stocks are going to be good. Your energy, your Minute Maid, your food things. So as those prices go up, people are going to go over to those basic staples. Usually, historically wise,
Yeah.
when we have a recession or stagflation, what's not going to be so much attractive is maybe Nasdaq and stocks in the Nasdaq. Your Meta, your and all that. You see, they were hot during the recession, but
Right.
Lucid Motors.
huh?
Lucid Motors.
See, we hear victims, right? So there's tons of victims that's happened where
$70 to $18 a share.
What is that?
It's the startup company that's about to compete with Tesla.
Oh.
Yeah. So because of the whole Shanghai thing, they've been down since then because they're not able to get like the parts and like the chips and stuff. So that's taking a big hit too.
yeah, and I think in the long term also the EV market, since the whole Western world is trying to push for EVs, I think
That's that
everything
lithium,
you take on-
lithium, baby. That's
I
that
think in the
lithium.
long term it's gonna be great,
Yeah.
right? Because now you have United Nations have. The problem is how's the United Nations about to be in the future? Because there's a huge rift. Everybody should watch this thing by Ray Dalio. He has a great talk on YouTube, if you've never seen it, about the change in the guard. And I think we're going through this huge change of guard where even when you hear about Ukraine, I think, okay, where America tells all the countries you should denounce Ukraine, tell them how bad they are. But then if you hear China, China's blaming the United States.
Yeah.
And now you have this huge battle
Yeah.
with it. And you see the Saudis saying, screw you, Joe Biden, we're not going to answer your cell phone. We're not going to answer your calls, and we're going to sell more oil to you and not pump out more oil like you would like us to.
And you know what? I saw that the very day you told me. I went and looked into it, and yeah, I saw that like the very next day.
So instead of us going through the globalization, we're almost getting back into people being more tutorial and holding on to their land and instead of this global economy where it's not like that. It's getting more and more. I gotta get mine, you get yours, and not going to work as a world unit.
Yeah.
And that's because we're just going through this changing of guard right now, which
Yeah.
is interesting about who's going to be the dominant world power.
Yeah.
So great time. Any other questions or anything?
When you was talking about like investing, like I think you said like
Gold is also another one. People usually in times of
Yes.
inflation, people
Yes.
always look at gold. Gold and silver is always a hedge for inflation. When the dollar collapses, drops, usually gold and silver usually don't do that good. But during recessionary periods, gold and silver usually do well as well.
you think cybersecurity is something that's good to invest in right now?
You know how many new credit cards I had to get the last 3 months? It seems like I got hacked a few times.
Man.
And any type of security, cyber security, police security, any security. Security out of my car bus window in the bed. Any type of security is gonna be good.
Top flight security.
Top flight security is gonna be good. I don't care what type of security. The world is crazy right now.
Yeah.
I was watching the thing on the news. If I got here in San Francisco, how people at some park off of Mission Street, where they just sit between 3 and 7, they made it to the flea market, and all the properties busting your car and they selling it. They're like, oh, what do you want? I got PlayStation, I got laptops, whatever you want, 3 to 7 every day. At least 3 years, and the police haven't done anything about it.
Oh.
And then there's another time the person got their car broken into. This guy was having the camera on scoping, and the police came, whoop, whoop, and the people was speed chasing San Francisco, and the cops couldn't do anything. See, we don't chase people.
That was last night.
Yeah, it's crazy.
Like
So
that.
any type of security any type of security should be winning right now. Because it's not just San Francisco. Crime rates in the United States has went up. I think we got too far to the left, and we just got to bounce it back up. And
Yeah. But police, they don't want to get, they don't want to go, chase somebody, get in the line of fire, and they got to shoot, and they got, they're going, they scared to shoot right now. They worried about what will happen if they have to defend themselves.
they have to defend
If
themselves.
they get in trouble.
Yeah, they're gonna get in
Right.
trouble.
They get in trouble, then the DAs, like in San Francisco, the DA in the police department, everybody has a fight, they don't even get along. Like, they throw each other underneath the bus all the time. The DA, they're just trying to recall the DA in San Francisco.
Wow. Again? Did they do that before?
Yeah, he just got elected like a year or two ago. But then he said he's too left. Yeah, he got too much where you have people, what did one lady say? There's one guy, he's a stalker, he got arrested like so many times, supposed to go to drug rehab. And it's a good series on this, I think Channel 4. And he supposed to get arrested a bunch of times. He get arrested and get released. He's supposed to go to a drug rehab house, and he refuses to go. He goes for 1 day and leaves. And he gets arrested. He knocked on one lady, she's a single woman. He knocked on her house naked before, and all types of stuff. So it's unfortunate.
Yeah.
And he needs help. He has a mental health issue, which we have a mental health issues in the United States. And he's not getting the proper help and services, and then he's being a nuisance because of that in the community. And I understand I have family members who are like that right now. They're not getting the proper help, and the schizophrenia and self-medication kicks in, and that makes things even worse. So,
Right.
anyways, let's pass it on to Steve. You hear about opportunity zones. I'm very excited about opportunity zones, about the future, the fund, investing in it. Like I said with Steve, 10 plus years. And when I talk about commercial real estate, Steve is the guy for it, especially when it comes to the multifamily space. There's nobody else in Oakland who's doing it quite like him, especially young here. A bunch of old heads in their 70s, 80s talking about multifamily, but not somebody who's just turned 30 last week, so.
Hey, a round of applause for James. Man, I just turned 40 2 months ago, and I feel like I'm 50. That hurt. You know what I mean? And that's you mentioned what the economy, what's going on this year, and it has definitely been. You said stagflation, right, or stagnant, and we've definitely seen that. In our practice, we have for surely seen that, and we talked a lot about this concept or this idea of uncertainty. And I think last year was one of the more certain years that people had. People were beyond certain. We had 4 different cash deals on office buildings. And I typically sell apartments, right? We had 4 different cash deals on office buildings. Commercial real estate in the middle of the pandemic. A couple people called me, they had a property listed for a while, out of nowhere, cash offer, 2-week close, right? And I was sitting back and said, well, what's going on? It was so much money in the system. You talk about it. All the money that got printed by the Fed, all the money that people were taking and refining out their house, people were getting stocked in crypto. People in the hood talking about we riding Dogecoin to the moon. You know what I mean? And that's kind of what it was. Now, what we're seeing is here and now is definitely a different channel. I say residential is a little bit different than commercial leasing is for sales world, because they're still getting multiple offers above asking price on some properties, not all properties for sure. Last year, you put a house out for sale, it was getting sold. You know what I mean? No matter what it was 25 offers, people fighting over it. There's this Redfin commercial they got that says the housing market, some lady walks up to the house and grabs it and hugs it, and that's kind of how it's been, right? Now we're seeing a little bit of a shift. You know, we talked about 5% interest rates. When I got into business in 03, that's about where they were, right? And 2% last year. If you could get a 2%, there was 2% mortgages on apartment buildings. So that's why we saw so much certainty this year, last year. And now this year we're seeing a little bit of uncertainty, which isn't necessarily a bad thing. A recession, not necessarily a bad thing. Interest rates going up. It can cause some heartburn, right? A little bit of heartburn, a little bit of acid reflux. But actually, at the end of the day, like what Jay was saying, that means it's a higher rate of return that you get in the marketplace, right? You put your money in the bank, ideally you get a little bit higher interest. That bond, ideally, because you know these banks.
Because back in the day, you was getting 12, 14% in the savings account.
I remember, so there is this rap group called Mobb Deep, right? And they had a song, and then this was 90s, late 90s, and part of the song was put $1 million in the bank and live off the interest. Like interest, you get 5% off the bank back in those days. And $50,000 a year was a lot of money back in those days, right? We're in a different world. So you might get a little bit more money in the bank, but that bond thing that you was talking about, that's why I asked, okay, well, where's the opportunity? I started a company, Infinity Investments, in 09, right? And that was a tough time to start a company. You know, it was blood on the streets, in the real estate world and everywhere, right? And so it was very difficult. And having started in 03, I saw the run up and I saw the shift, saw the crash. What I also saw was the tremendous amounts of opportunity that there was in that marketplace. However, there was a shifting. It took a few months from October 08. I remember being in contract on the deal. We had an apartment building out in Ohio. We had a buyer for that. We had fixed it up, rented it out, we're selling it. We're in escrow, getting ready to close. We get back that Monday. The stock market dropped like 777 was like the stock market drop. And he called us and was like, "Hey, I'm out. I'm not doing the deal." And I remember in my real estate office, there wasn't a deal. There was 2 deals that got closed from October to the end of December. And this was, we had 2 offices, about over 100 agents. So there was a period of time where it was just stagnant, that, you know. Then once it started rolling, you saw some of the deals of the century, right? And that's when I got started. So I started a company in November 09, and firm. We specialize in apartment buildings and other small and mid-sized commercial real estate. And I've had the great honor to serve on a few boards. Association, which is the Oakland chapter of NAREP. NAREP is the Black Brokers Association. California Association of Real Estate Brokers is the California chapter of NAREP. I had the opportunity to be president of both those organizations. And then I also had the opportunity to be president of NorCal CCIM. CCIM stands for Certified Commercial Investment Member, and that's a commercial real estate designation, but it's also and more importantly, it's a network, a group of people where we get together, learn stuff, and do business. And that's the great part about having physical meetings like this. Again, nothing to take away virtual meetings. They helped us keep things going, but it's great to get back amongst the people, because this is how a lot of deals get done, right? And today we're going to talk about opportunity zones, what they are, the significance of them, the pros and cons, how, give you an example of kind of, somebody who has a capital gain and then would invest into an opportunity zone. So these are possibly another vehicle, another way to benefit during a stagnant time or a shifting time, especially if you've seen asset appreciation in a property that you have, maybe a business that you have, stocks that you have, cryptocurrency, whatever, where you've made a gain, right? We were talking about earlier, Jason, he was talking about capital gains tax rate and ordinary income tax rate. So capital, ordinary income, or income tax rate is based on your income, the money you earn. Capital gains is based on your asset growth, and when you realize that gain, you sell it. Now you have to pay taxes on it, right? And so what the opportunity zone allows for is a nice deferral of those capital gains. And so I'll break that down and see what that means. I also compare that with 1031 exchange. How many of y'all have heard about 1031 exchanges, right? That's a great way to defer taxes in real estate, right? That doesn't exist though if you sell your company or you sell your stock. But I'll compare both of those, and then we'll talk about some action steps, right? Thing I think we like to do, and we've been rocking for a while, is make sure we provide information and also say, okay, here's some that you can take to make that, to take the information and make it work, right? If we're not doing that, what good is the information, right? So what is a qualified opportunity zone? Now, first of all, this designation came as about in 2017 as a part of the Jobs Act, the Tax Cuts and Jobs Act of 2017 under the Trump administration. And essentially it allows for certain investments in lower to moderate income areas to have tax advantage. And those tax advantages have to do with the deferral of capital gains. So let's say you sold the property, sold the business, sold some stock, you have a gain, right? Let's say you have a bunch of stock and you said, all right, well, the market's shifting, I made a bunch of money, now it's time to get out. Good move, right? But if you made a bunch of money, you have a profit, you have like a gain, where you now have a taxable. What an opportunity zone allows you to do is to take that money and reinvest it into an opportunity zone fund where you can defer your capital gains. Now, with this program, with the purpose of this program was to put capital to work that would otherwise be up due to the asset holder's unwillingness to trigger capital gains tax, right? For us that are real estate agents and brokers out here, we probably have talked to someone in the past where we talked to them about selling their property and their main objection is, I don't want to sell that property because I would have to pay taxes. I'm making a whole bunch of money. Why would I sell and then have to go out and pay capital gains taxes, right? That's a valid, I don't say excuse, that's a valid objection, right? And so we were talking about doing an exchange, and so maybe they don't want to exchange, right? And so that, with the opportunity zone, came about as a way of saying, hey, let's create some capital and deploy it in areas that need investment. So there's maps, right? So the zones, opportunity zones, are census tract areas, generally of economically distressed communities that qualify for the opportunity zone designation, right? And there's a map that has been created across the country. What's weird about the map is that some, like on MacArthur, East Oakland, parts of the street are on the map, parts of the street ain't on the map. But that is how it happened, right? So that just is what it is. Now, that's an opportunity zone, the area, right? In order to really take advantage of this tax deferral, in order to really take advantage of this program, you've got to put together an opportunity zone fund, or the person who has realized that gain has to invest into an opportunity zone fund, right? And what an opportunity zone fund is a U.S. partnership, a qualified opportunity zone is a U.S. partnership or corporation intends to invest at least 90% of its holdings in one or more qualified opportunity zones. All right. So that fund essentially get LLC or corporation that gets set up.
Can you set that up in an S corp?
Yep.
So you can do taxes a little bit different.
Yeah, and most of them are LLCs, but because it's either a corporation or a partnership, and so it could definitely be an S corp. It could definitely be an LLC. It could be a multi-member LLC. It could be a single member LLC.
You go from one 1031 exchange, you just flip it from one to another.
Well, a little bit. Great point. It's longer term than exchange. Once you get into the zone, the one thing I'll talk about some of the pros and cons. The one thing is it's totally a long term investment, right? So whereas 1031 exchanges are as well, But opportunity zones, you really get the benefit from being in that fund for about, if you hold the asset for 10 years. Because if you hold the asset for 10 years, the new growth on the asset, you don't pay any taxes on that new growth. So
Can you invest it in a trust?
you can, I don't see, there's a bunch of, what I would say, there's a bunch of little legal, I don't want to say loopholes, but there is loopholes and there's a bunch of little legal issues with legalities. But I don't see why you couldn't invest it in a trust, because it's just, it is simply just an entity. But it's a special entity that's set up just for doing 90% into investment into the opportunities.
I'm just asking because if I raise capital for it and start a fund, that's where we can warehouse it. And I'm gonna have them warehouse it through life insurance, and then I'm gonna take it out of that and put it into the.
That's smart, actually.
I've got like 4 layers.
Yeah. So I mean, I don't see why you couldn't do it in a trust or any entity of your choosing, right?
Okay.
Now, I'll tell you also, been doing this.
We don't provide legal service?
Right. No
You talk
legal
to an
service,
attorney
no
about
reference, the warranties with, but what I would say, you do need to get an attorney that is had some experience with opportunities on. These are newer. The 2017 is 5 years ago, but this is newer, right? So it hasn't been done a lot, and a lot of lawyers don't know about it. I'm working with Steve Wilson from Withers and Bergman, and they're a top corporate firm, but they've done a lot of these opportunity zones, right? So, but I don't see why not. I think that's actually a great idea.
I'm trying to figure out how to pitch my guys. You know what I
Yeah,
mean?
yeah.
Because I got all my stuff figured out, guys.
Yeah.
Here's how we're gonna do it. So.
Yeah.
It's crazy while I was talking, there was just a $650 million opportunity fund deal in Las Vegas, right next to the football stadium they just got done. Where they're about to do about, I think, 900 units of apartments.
Really?
Yeah.
That makes sense. You know,
It's an opportunity fund, you put in
Yeah.
like a 600 plus million in it.
I'm gonna go up to Reno and do it, and the DSCR on the property there is way better than it is here. You know that, right?
Yeah, all day long.
Your guys bought those cash deals because they need to park their money somewhere, and they bought it at a discount.
Yeah.
Now they'll go back up and they'll want to take the loan out before the rates go up even higher.
Right.
I got it.
Bingo, right?
They'll go in too, so.
No, that makes a lot of sense. Especially, let's say in that instance, or the instance you're talking about where you set it up that way, if you sold the property, or if you sold the stock, or where you made all this money, and 1031 exchange can be good, but it's also, there's some rules that may not be copacetic if for what you're trying to do. But let's just say you sold a company, or you sold some stock, or you don't even have that option in 1031 into a property deal. But now you can roll that into a fund, and now you can get, and the fund can be structured to go pay cash for properties, or get some economic leverage. Now that makes a lot of sense. Now that's a way.
I want to do more than one, is what I'm saying.
Yeah.
I want to raise capital. We're going to get this one going, and guys, we're going to move it right. We're going to build an empire here. Opportunity zones. That's why I'm asking you like that.
Well, I think what you're doing.
That's why I'm driving from Morgan Hill to Meeting.
Right. But exactly, I think, and when you talk about timing, right? That's exactly why I think now is the time for something like this, because people have. You talk about that run up, right? What is it? 33,000 Dow Jones or whatever it is.
Right.
I remember when it dropped down to 19, right? So like when that was March or April of 2020, whenever it dropped down.
That October, it was that October in 2009.
Yeah.
Well, that was at March 2020.
Yeah, and it drops all those points, right? So somebody's made a ton of money in that time. So even if they said, hey, you know what, scared of the market, I'm gonna get out, they're gonna have a gain, right? And they need to do something. So this is an opportunity, and what I would say, and we'll talk a little bit about interest, what they are and what they're comprised of. Now, here's one thing about the OZs, is because they are intended to stimulate positive growth in designated communities, there are restrictions on the type of investments which the fund can invest. And these investments are called qualified opportunity zone property. So you can't just invest in everything. There is some, I don't think you can do cannabis or alcohol or certain type of businesses, but just in terms of the type of an investment, or the type of property that you can invest in. Partnership interests in a business that's operated by a qualified opportunity zone. Right? Stock ownership in businesses that conduct most, not even all, most or all of their operations in a qualified opportunity zone. And then property, such as real real estate located within the opportunity zone. I think the vesting, I don't see why you wouldn't be able to invest like in a trust or other type entities, but these are the more important points here. Partnership interests, stock, actual property, right? And you can invest in, so I think the biggest thing here to think about is businesses, they don't have to be buildings, you can be businesses, right? And either the whole business or a fractional interest in the business, stocks in that business, it opens this up, and that's the key to understand.
So think about like a business is like look at like the old like Granny Goose right down the street used to be the factory.
Yeah.
That's, let's say someone wanted to reopen that and start making chips again. That's an opportunity zone. So I can invest in that chip company if they open up that Granny Goose factory on 80-something hills in Yale, and now we're investing in the opportunity fund zone fund.
No, that's funny you say that. I know a guy who owns the old Mother's Cookies, and he's got another business in there. But all of those businesses, you could take that, put another business in there. This whole thing was created as a way to move capital around, right? In a tax advantage way. And this is, I think, when we're in it, we're talking about stagflation, we're talking about higher interest rates, we're talking about recession. Every penny that we can maneuver towards our advantage, is what we need in a legal and ethical and honest way, is what we need to be trying to do. Because that's why I was asking one of the opportunities that and this I think is huge right now. And that's why we're going all in on it. And I think other people like yourself and other funds that are set up, it only makes sense. And as things tighten up, access to capital typically tightens up. And there's a bunch of this type of capital floating around.
Do you get any other credits if you throw green initiatives in there as well?
Yeah, they got so there's all kind of different, most opportunity zones are also located in economic empowerment zones, and then there's all kind of state tax credits and federal, especially in California, we got a lot of state tax credits for different energy products, and different, like if you're going green, doing solar, and all of that stuff. So that all kind of, combines into the overall, tax advantages. So yes, now every area is specific, every state is a little bit different, but absolutely. And I know in our state, anything you do green, you getting some brownie points in the form of tax credits or other benefits for sure.
It's like when the Model 3 for Tesla, when they started notice they get like $8,000 back on because you don't have to use gas.
Absolutely. Well, like for instance, let's just say you build a building, you do the opportunities on there, you got all energy efficient, everything, you got solar panels, right? You got a water filtration system that recycles a bunch of water. Now there's typically tax credits for each one of those products in one way or another. But again, a lot of those tax credits are through the state and may be different. Right?
Carbon footprint tax credits.
Yeah.
You still get your depreciation credit.
Oh yeah.
That's the huge one anyway, too.
Absolutely. And another thing to think about, I'm glad you mentioned depreciation, because all these opportunity zone deals are heavy. There must be, and I'll get into this, there must be a heavy investment into the build out, right? The renovations, and there's a formula, so I'm not going to go over that. But what you can do, a thing that you can do to really benefit you when you're doing heavy renovation projects is something called a cost segregation study. Cost segregation study can essentially, they look at all the fixtures and kind of attachments, and they come up with the value for that, and essentially it can accelerate your depreciation schedule. And basically what that does is that increases the rate of return in the short term for the property. The negative or the con of that is that, it accelerates your depreciation schedule. So as time goes by, you lose some of that depreciation that you have because it's kind of front loaded. Now, an opportunity zone is a long-term deal in nature. In other words, when you invest into an opportunity zone fund, you can defer some of those gains. Now, if you hold that asset for 10 years, that new investment that you made into the opportunity zone, that now becomes totally tax deferred. So if you accelerate the depreciation schedule, now you don't have to pay tax, and you hold it for 10 years, you don't have to pay capital gains, and therefore you're not so worried about, squeezing out your, depreciation schedule. And if you guys know the schedule for like apartment buildings, I believe it's 27 and a half years. I think for commercial it's 39 and a half years. I might have it, maybe it's backwards, but when you get a property, if it's apartments, you get that amount of depreciation broken up over those period of time, and you get to write that off on your taxes. And that either helps you pay less in taxes, or it helps you not pay taxes at all on your investment property. And when you do a cost-seg study, that allows you to accelerate that. Basically, you get more of the benefits up front and not stretched out over 27 or 39 years. But when you do an opportunity zone, you're not so worried about that, because if you hold it for 10 years, then you're not paying taxes on that new growth at all, right? So, a couple of ways of how it breaks down, though, right? The fund is the parent entity, right? So money comes in to the fund, the parent entity, or the holding entity. Or let me say this, the fund is where the money comes in. The fund then invests into the holding entity. The holding entity is the one that owns or controls the business, the property, the stocks, the operation. So there's a fund up here, the parents that then invest down into the project, if you will. Those are two different entities. The fund, the parent, and the project, which is, the money gets funneled directly into, right? And in doing so, one thing that keep in mind is that you're essentially investing into a group. You're investing into a fund, a pool of money, right? And that fund invests into qualified activity, and in doing so, you defer to capital gains, right? Now, one thing to bring up, this great Golden State of California winner. California Franchise Tax Board does not recognize the opportunity zone deferral. So if you made your capital gain in the state of California, you can defer your Fed capital gain, which is at least 21%, defer your California capital gains. So that's it. It's good old Uncle Gavin, and then sticking it to us. But that's, it's what it is. Now, if you realize your gain, let's say in Utah or Texas or somewhere, and then you put that and invested that in California, you're good.
Can you say that again, please?
Yeah, so if you realize your gain in California, so you sold the business in California, right, and you roll in an opportunity zone fund, you have to pay California, their portion. You don't have to pay the Fed.
Okay.
If you sold your business or you sold your assets, or most other states, I think California is the only state that doesn't acknowledge the opportunity zone fund deferral. When you sold it in Texas, and let's say you're doing the deal here in California, where it's an opportunity zone, you can take that money from Texas and roll it into California without having to pay.
As long as I'm from Dallas, so it's as long as the entity putting the money in is not a California LLC or S corp.
Yeah.
That's all.
Yeah, and there were tax stipulations on
You
that.
ain't make the revenue in California either, though.
But yeah.
Because anything you make revenue in California, all the money you pay pass go.
Yeah. You know how it is. But you can take the money in and not have to pay the gain tax. It's just, if you realize the gain here, they're gonna get you. So that's just a little caveat right there to understand. Great Golden State, like what you said, there's been a lot of people leaving. We still got the most billionaires, we still got the best weather, but we have some tough policies to be able to operate and do it and run a business and live life, right? That's just one thing to understand. Now, in order to qualify, we talked about there has to be heavy investment into renovations. Essentially, what that means, every property has an allocation of land value and improvement value. And the way you just figure that out is you look at a property's tax bill. And it's going to give you the allocation of land and improvements, right? And it may be way off from today's market value, but we're just talking about the assessors, assess the value. And in that, there's going to be a breakdown of land value. There's going to be a breakdown of improvements value. you need to invest at least the amount of the improvements of that property or more in order to qualify. You cannot just buy an up and running apartment building that's already clean and pristine and think you're gonna qualify, right? If you buy a business, you have to reinvest into that business, right? Now, and a business probably is a little bit more complicated on how they figure that out, right? Because the allocation and all that stuff. But bottom line is there has to be a significant investment into the improvement of that property or that business, right? Very, very important piece on that. Because I say that because, you know, the real estate world, I love us agents and brokers. A lot of people put on their property, oh, it's an opportunity zone. Fully renovated, this is located in an opportunity zone. Well, if it's fully renovated apartment building, you really can't do nothing with the opportunity zone, right? It's a marketing piece. So one part about it, as an agent, as a broker, it's our job to do everything we can do to spotlight the property and make it look rosy and great. But if something's fully renovated and running, you can't just simply, you know, roll into it because you have to invest that money into the operations, into the improvements.
You mean like if it's already perfect and put together, the opportunity for scale is going to be lower?
Not necessarily opportunity for scale. You're not going to qualify because in order to qualify, qualified activity means it's got to have the investment into that property or project equal to the improvement value. So let's just say this building, for instance, right? Say this building is assessed at $2 million, and the land value, and this is just the assessor, how they set it up. Every property has this on their property. The land value, let's just say, is $500,000, and then the improvement value is 1.5. So $2 million building on a tax bill assessed. Tax bill says land is 500,000, improvements are 1.5. So let's say we wanted to do an opportunity zone deal on this place. We'd have to spend at least 1.5 or more in order for it to qualify, right? If we come in and we spend 500,000 and the improvement value is 1.5, well, then we're not going to, that is not going to be a qualified opportunity. Doesn't mean that it's not an opportunity for scale, because it might be, right? And you might want to buy that property or invest in that property just on GP because, hey, it's a good deal, right? And maybe it has an opportunity to grow in value and scale, cash flow. But from an OZ fund standpoint, it's not going to qualify. Does that make sense?
So a perfect example of who done that is the Rams Stadium was an opportunity zone fund. So if you look at the Rams Stadium, before it was built for the Rams within the Super Bowl, it was just done. And they put all those capital, they put what, $2 billion into it?
Yeah, that's
Perfect example.
stadium.
And if you look at most NFL stadiums, they're mostly all of them, all the new ones are all opportunity zone fund areas.
Yeah.
So the Raider Stadium, opportunity fund area. The new Falcon Stadium, home. So you get these, you buy dirt and then you improve on that dirt, so it's easier to.
There's no stipulation on what it's used for. I would think this is to make the
Yeah, no
community
cannabis.
better, though. You know what I mean? Like you're enticing investors to put their own money into building a neighborhood back up instead of the government having to pay for it. That's why you get the tax credits, right? You see
Right.
Or
why would they live at a football stadium?
let's think about this. Let's look at this. So you making these tax cuts to simplify because they're too complicated, and we were trying to stimulate the economy at the time. Donald Trump was trying to stimulate because remember he said we had the best economy of all time. So that no matter what, his whole goal and objective was to stimulate the economy so he could go back and say, this is the fastest growing economy of all time. He didn't care how it was done or who it would benefit. At the end of the day, he was trying to say that he had the best economy of all time and was roaring and the fastest growing. So, let me hook it up with me and my boys.
Well, you hit the nail on the head. Like you say, you put it on steroids, right?
So he can brag about it.
So he can brag about it.
Exactly.
Some of that's the ripple now we're seeing too, but not all of that.
Well,
and a combination of a lot of stuff though.
Well, look, it's like this too because, you know, when Biden come into administration, everybody, it hasn't really hit us yet, but everybody's anticipating tax hikes, right? Everybody, when the Democrats get in there, we know the tax is going up. At some point, probably have to go up at some point. Hopefully not now. It's just bad timing for that. But a lot of people are looking around. What is capital gains rate or income tax rate? Every time there's a talk about raising taxes, they talk about 1031 exchanges. And I think if they eliminate 1031 exchanges, that would be the stupidest thing of all time. And the realtors have a good lobby, so I don't think that's ever going to happen. right? Because Republican or Democrat, everybody loves real estate. And so, but that's always on the chopping block. It's always on the discussion. They've said that, hey, we're going to keep the opportunity zone going because the idea is supposed to have community benefit. It's supposed to uplift the neighborhoods, right? But as we've seen, you mentioned all the deals that got done, you know, and a stadium could potentially bring value to an area, but what it does end up doing a lot of times is pushing people out. Neither here nor there. The reality is,
It's jobs.
you know, it does create jobs. I mean, the one thing
Small
about
businesses around
the
it.
one thing about the stadium, and not to, you know, as a Raider fan, not to get off topic, but it would have been great to have a nice Raiders, that stadium they got in Vegas, could have been right in Oakland. And you can imagine all the jobs it would have created, all the revenue that comes on the weekends, people partying and all this type of stuff. So they can argue it has a community benefit, right? And it's supposed to. And I think this is where we as the people, for the people, by the people, do have an opportunity. Because like what you're talking about, the big boys and girls of the world, they're going to go out there and make moves, and it's always going to be in a tax advantage rate for them. But this is just something that allows small entrepreneurs to go and access capital, big time capital, that is out there, where maybe we wouldn't have had that access before, right? And then we could take that and do some community good. Like what we were talking about, the guy with the baseball complex idea.
Right.
That would be a great project. We got a buddy that, you know, does a lot in the world of MLB and youth baseball, and it's got a great idea for the opportunity zone, right? And so, but this is where we can take the bull by the horns and make something happen, right? And some of the couple of benefits is you can realize your gain and hold your gain for about 18 months. Versus, let's say you do a 1031 exchange, you got 180 days, you really got 45 days to identify a property, so it's tight. You can hold the gains in your business account. If you do an exchange, you know that money don't go to you, it goes to the QI, the qualified intermediary. So it sits in that qualified intermediary's account until you make your move. Let's say you set up a 1031, and I love 1031s, by the way, YouTube, because I do a lot of YouTube videos about 1031. But, okay, some toughness about that. And one of the things is, let's say you're in your 45 days, and you don't identify a property, or the properties, it goes bust. You're like, all right, well, it didn't work, I need my money back. QI is going to hold your money for 180 days, and then after that, they're going to give it to you, right? And then you pay your taxes and do what you do, right? So that's the opportunity zone. You can hold those funds in your LLC account until it's time to disperse it, right? Again, talk to your CPA, talk to your attorney, and these are some of the basic benefits. And again, if you invest into that fund, and that fund holds that project for 10 years, the new growth, so you rolled into this fund, or you set up the fund and had people roll into it, you held it for 10 years, the new growth, you ain't paying any taxes on it, capital gains taxes, right? So that's the real benefit. And a lot of this big money is long-term money. Like you talk about investing into the stadium, that ain't a quick flip. You know what I mean? Oh, they probably made a nice flip money on the Super Bowl. And that's how we knew that the Rams was gonna win. That's a whole other discussion on that. But that, you know, all things being said, it's long-term. Talk about some disadvantages, right? First of all, in the state of California, you have to pay taxes. Now, this is a gray zone that I am not truly, absolutely clear on. There's an event that has to do with 2026 where you may have to pay some of the capital gains. Now, this is, you know, where you do need to talk to a really good attorney and make sure you set this up, but there's something about 2026 that is, and I don't know why they set it up that way, but there may be a taxable event or prepare to pay partial of the investment in your, maybe prepared to pay actually fed capital gains taxes in 2026. So this is the part where I'm really still not absolutely clear on. However, what a lot of opportunity zone funds are doing, they take the capital in, setting aside a certain amount of capital. If they have to pay some taxes in 2026, to be able to do that. Although, you know, I'm not exactly sure how that breaks down. Now, another thing that's a negative is essentially you are invested into a pooled group, right? And so you don't have absolute control over that money anymore, right? You're investing. So I used to do this presentation, group investing and opportunity zones together. So I broke them out because they are similar, but they are also two different presentations. But the similarity is when you invest in the opportunity zone, you're investing in a pool group. It's a syndication, right? So you're investing into a fund, and you don't have absolute control. If you buy your property, you decide when to sell, buy, refi. That's on you, right? And there's several unknowns, and it's subject to changes in tax law, right? Like if you do any research or you were active in the 80s, right? There was a big tax reform in 1981 that deregulated, a bunch of industries, and that created a bunch of major tax write-offs for the real estate world. And so you saw a boom in the stock market, you saw a boom in the real estate market, you saw a boom in the economy in the 80s, really based on this tax law, because you could buy real estate and lose money, and you got big write-offs for it, right? You got rewarded for actually losing money. Over and beyond the depreciation that we have now, people were buying investments and investing in real estate for the purpose of losing money. Doctors, lawyers, professionals. That was big. 1986 came around, and then the Tax Reform Act, the Tax Reform Act in 1986, and they took that right off away. So you can imagine what that did to especially commercial real estate, right? Because a lot of people were investing in these. I'm sure they syndicated houses too, but a lot of people were putting money in deals, especially for commercial apartment buildings and stuff like that. And so when they took that away, we had a big debacle, the savings and loan debacle. In 1987 was the stock market crash with Black Monday or whatever they called it, right? And so that all happened. So every time I do a presentation, I always talk about the pros and the cons. Saying all that to say, I'm not saying don't do the opportunities on. I'm saying we should do it. But knowing that these things are possible, then what we should be doing is make sure that whatever deal we do should be based on its own merit a great investment. Not just, hey, this is an opportunity, it's located in opportunity zone, so that makes it great. It's like, well, this property is a great investment in and of itself, and it's located in an opportunity zone. And that's the cream of the crop. We can do this fun, we can bring money in. It's like when agents are marketing properties, that should be one of the benefits, not, hey, opportunity zone, buy it. It's fully occupied, it's great unit mix, room for growth, it's in a transit area, and it's an opportunity zone. That's kind of the point I'm making on this, all right? Now, as we get ready to rock, I'm gonna kind of give you an example. Now, this example, take it with a grain of salt because everybody's tax situation is different, right? I'm using some basics, and I'm using real estate because I wanna kind of compare it to a 1031, right? Say you sold a fourplex and you realize a $500,000 gain, right? Now, in California. So in California, you're gonna have to pay 9.5% minimum. It could be more than that, but at least that. And that would be $47,500. And let's say you invest the remainder into an OZ fund. And that OZ fund is paying you out, say 4% annual income. Now, a lot of the OZ funds, from what I've seen, are paying investors 4 to 6%. So investors, they're not making 8%. They're making 4 to 6% of what they call like preferred return, right? So you're getting money on your money yield every year. Also the growth, right? So you're not just doing this and not getting any income, right? You might not be getting 20% income, but 4 to 6% ain't bad. And that might be changing, right, with rates going up, and when rates go up, rates of return go up in general. So that, that may change, but in general, people are making between 4 and 6%. So let's say in this deal you're earning 4%, right? That would be $18,000, $18,001. And let's just say in 2026, you had to pay all of the capital gains. Remember, I mentioned 2026, not exactly sure about how this breaks down. It seems like a bunch of the lawyers in the OZ world, this is a gray zone. So if it's gray, I say be conservative. So let's just say the Fed say, hey, you can roll for a few years, but in 2026, you need to pay that capital gains. That amount, let's just say, would be 105. Right? You pay 105 in the capital gains taxes. Now, if you held it for a few years, you're making 18, you almost could pay your gain taxes with that yield that you were making. Another thing to remember is that the individual investor is responsible, not the fund. So if the individual investor invests and they need to pay gains, it's not on the fund, right? So they may want to invest and hold some of their investment back to be able to pay some of that. The idea is that even if you had to pay in 2026, you had capital working, hopefully earning you yield, bringing in return during that period of time. hopefully you have to pay all the capital gains in 2026, but let's just say you did, right? And that would be, in this example, $105,000. But let's say you held that investment for 11 years and the equity doubled in value. Now you have no capital gain, right? So let's just say you paid $150,000 in capital gains over the life, state and fed, 100-something thousand of which you could pay from your yield, right? So you would have to pay that over time, but now your 452 doubled in value to 904, and you don't pay the taxes, right? And so in this example, it's conservative because this example means that you still pay taxes in 2026. I'm not sure it's going to have to happen, but I'm just being conservative, and you still come out way ahead, right? And if you're the person putting this together, kind of like what we're talking, this is a major event. You know, talk to investors about especially the big funds and big, groups out there that are having these, gains, and bring to them an opportunity where, hey, if we stay in this deal for a while, 10 years, there's no new gain. And we know dang well, maybe the market will go, maybe we'll have a market crash during that period of time. But if we hold it long enough, like if, for instance, if you bought your property, right, in 05, let's just say, had a nice run up and it crashed, right? You probably lost all your equity, you probably upside down. If you have that property today, you're up. Now, here in the Bay Area, I would say most markets in the country, because you held it long enough, right? That's one thing that I don't think we talk about enough in real estate and investments is longevity, right? And that's the big benefit of this, is if you hold it long enough,
It's going to eventually bounce back.
well, the market's going to eventually bounce back, and you don't have to pay any new growth in the game, right? And that is the biggest killer of wealth, typically, outside of foolishness and bad moves, is taxes, right? You know what I mean? I say outside of foolishness, because that's when people fumble and bumble wealth. And I've seen, in the real estate business, we've seen a lot of real estate is owned by families. I would probably say, right, a lot of wealth stocks and companies too, same thing.
Right.
But real estate holders, they're companies, but they're families, right? Especially on the individual market. And I've seen so many people, the second generation, fumble the ball. Mom's dad made a legacy, they bought a few properties, they had them free and clear, mom, dad passed away. Little junior over here, he got the property, he just sell the property off. He can go to Vegas, he's living good for a couple years, he coming back to the Bay Area, he can't, he living in the sidewalk, in the sidewalk in the tent community. Because
on High Street, next to Home Depot.
That's the Home Depot, right? Now, and I hate to say it, but I've seen that happen a lot. Millions of dollars. Especially, so that's probably the biggest killer of wealth, the taxes. That's why the wealthy are always concerned about it, they're always thinking about it, they're always lobbying with the government for it, they're always making laws, right? So we have to be cognizant of where. Now, just a couple to compare it with 1031s. Again, I love 1031s, do them all the time for clients, I believe them. But sometimes, like you try to do a 1031, if it crashes or it doesn't work, one thing you can do is, and you're still trying to defer gains, you can roll money into that OZ fund. That's totally possible. Now, it's a long time to figure out what you're doing, right? There is no 45-day identification process. As a broker, when we're dealing, and I'm a client now, about to go into a contract on a deal, we're going to start looking for properties now. In fact, I've already been sending them the properties. Because I'm not waiting for the escrow to close, and I got stressed. She's stressed, I'm stressed, we all stressed.